Speaking of the stock market, that's my specialty. I think for any investors who have not sell in May and go away, the past few months has really been a nightmare. HSBC, we downgraded A-share market to sell back in April. And now I think, it's time to sort of reassess the situation a little bit. The good news is that I do think that the upside and downside risk appears to be balanced at this point. But the bad news, again, I think, it's going to take at least a couple of quarters for the domestic A-share market to come back to a normal situation. So that's why our advice to global clients is that for anyone who wants to have a China exposure, it's better to go through the Hong Kong listed H-share and red chips for three reasons. Firstly, valuation is a huge consideration, right? For the blue chip companies, the dual listed one in Hong Kong is 40 to 50% cheaper. And for the small cap companies, growth companies, small cap, the Hong Kong listed one is actually 70, 80% cheaper compared to A-share market. The second consideration is the regulation environment, right? We can see that the Hong Kong market, objectively speaking, is a much better regulated market. It's more transparent, it's rule-based, and the predictability is much higher than the A-share market. And finally, we also think that the global investors are actually over-pessimistic about China, right? If you look at the valuation, even in the Hong Kong market, it's sort of priced in a hard landing scenario in Hong Kong, but we don't think that's going to be the case. I agree with Mr. Lian Ping. Soft landing is still the most likely scenario in China, and the medium-term, long-term growth potential. I think it's not time to write off China yet. So those are sort of the key conclusion. With that, let me just talk about the two key concerns global investors have on China. Firstly, I think the global investors are worried that the Chinese government appears to be they're targeting multiple objectives at the same time. And sometimes, those objectives, they're contradicting to each other, right? Give you one example. For instance, the currency devaluation, the 2% devaluation happened on the 10th of April. Certainly, in my view, that's actually one of the key reasons why A-share market has had a second leg down. And also, I think, this is part of the reason why it has triggered a much widely sell-off across global assets class. So clearly, I think, the Chinese government must have neglected when they're, rolling out the currency policy. It does not take into consideration the secondary impact that the currency change may have on, the equity market. The second concern global investors they have on China is that, the policymaking signal appears, they're confused about the policymaking and execution. Remember that at the third plenum, China, sort of told the whole world that going forward, the market is going to play a much more decisive role in terms of in economic transformation, as resource allocation, so on and so forth. At the fourth plenum, the China assured the whole world that rule by law, that's going to be the key principle. However, if you look at what has happened for the past few months, including myself, I got a little bit confused. Let's take capital market as an example. In order to stabilize the spot market, what the CSRC has done is actually they decided there's a lot of measures obviously being rolled out for the past few months. One of the key things they have done is actually they're literally shutting down the futures market. Okay, the maximum position that any institution can build in this market, previously before the stock market crisis, it was 600 contracts in the futures market, which is equivalent of a 500 million RMB nominal value. So for anyone who wants to hedge the portfolio risk, you can go to the futures market, and you can build a position up to 500 million RMB. So for the past months also, they have actually cut down that number from 600 to 100. And a few days ago, they cut the number again to 10 contracts So that's equivalent of only 9 million renminbi. I think for any portfolio manager who manage billions and billions renminbi in a portfolio, it's really difficult for them then to go to the futures market to hedge that risk. So those are sort of the two key major concerns that global investors they have, and then that's why we do think that the next couple of months could be really critical. There are two good opportunities for global investors to reassess the situation in China. Really, what's going down the path. I think the first opportunity is to observe what's going to come out of President Xi Jinping's state visit in the U.S. How China is going to assure to U.S. to the rest of the world the new which way the new growth strategy is going to take China into. The second opportunity to observe to get more clear signal on China is the fifth plenum, which is going to happen in October. It's a good opportunity for them to assure the rest of the world that China is still sticking to the reform path that's laid out in the third and fourth plenum. So that's really the key of today's presentation. With that, I would like to just go through a couple of presentation slides. The first one is actually the reason, this is actually one of my favorite charts, why Asia market crashed. The two reasons behind that. Firstly is because, the fundamentals cannot really support the market performance. As you can see, PPI, is a very good indicator of profitability, and particularly for the manufacturing companies. So it's leading the stock market performance by roughly 4 to 6 months. And as you can see, there was a huge divergence since second half last year and then first half this year. But eventually the market is playing the catch up with the fundamentals. So that's the first key reason. The second reason behind the Asia market crash, I think, is also a huge gap between regulatory capacity and also financial institution. We know that in China there's a lot of ways to add leverage, i.e. through the margin financing, through OTC, over-the-counter financing, through structured products, also through the futures market. But in the meantime, I think the regulators appears to be that they have not fully comprehended the risk associated with leverage. So those are the two key reasons behind the market crash. And then looking at these slides, and clearly, for the past few months, the national team, i.e. through the CSFC, China Security Finance Company, has been doing a lot of things trying to stabilize the market. Again, this chart basically shows you how much money they have raised in order to stabilize the market. We cannot confirm or verify those numbers because it's not released by the company itself, but through various media report. So at the number up is roughly over 3 trillion. 3 trillion RMB is a big number, right? Put the number in perspective. It's about 8% of the total market cap in Asia, 10% of the total market cap. So far, how much money they have spent already? Again, that's we can only estimate. They probably already spent 1 to 2 trillion in order to stabilize the market. And then next slides. What this national team has achieved, I think you have to give them some credit. The first thing they have achieved is obviously it has helped to facilitate the deleverage in the Asia market. So this is the daily change of margin financing balance in Shanghai and Shenzhen. You can see that for the past 2 months' time, margin financing has come down by over almost 60%, i.e. 1.3 trillion. The remaining margin financing balance is less than 1 trillion. So definitely without state intervention, this is impossible, right? Because every single one wants to get out, every single one wants to sell, someone has to stand out to buy. And next page, if you can see that going forward, the further deleverage should be moderate, right? If you look at the leverage position, the most vulnerable position are those built in last December. So this is only 150 billion. And if you take into consideration the remaining leverage in OTC market through stock pledged loan, if you add the numbers up, it's roughly 800 billion to 1 trillion. So the remaining leverage position is fairly limited, and the CSFC certainly has enough resource in case those leverage position wants to unwind. So that's why I think that we have seen most of the sharp correction in the Asia market. Next slides. The second thing the state intervention has achieved is actually it helps to avoid a market liquidity crisis. At the peak in the beginning of July, we can see literally half of the market is actually suspended. There's roughly 3,000 companies in the Asia market, and now through the state intervention, through the refinement of suspension rules, we can see that this number has coming down substantially to a normal level. So those are the two things the state intervention has achieved. But next page, you can see that really the state intervention has done very little to help the market performance. As you can see, the major indices in the Asia market, they dropped since the state intervention. It has dropped another 15–20%. So which tells you that the intervention is market impact is fairly limited. And even more, next page, you can see that this creates a lot of price distortion in the market, and this is for the dual listed company in Hong Kong and Asia market, the same company. The premium index shoot up whenever the state national team decided to intervene. So you can see that in the beginning of July and also for the past couple of trading days, this A&H share premium index surged over 20 percentage points. A good example is ICBC, right? Before the military parade, which is attended by the President Park, on the 3rd of September, the two preceding trading days, ICBC in the Asian market shoot up 20%, but it actually in the Hong Kong market, it dropped 2%, right? So which is a clear evidence of market distortion. And that's why I don't think the state intervention could be sustainable going forward. Next page. That's the example I talked about ICBC. The same company, same fundamental, and within 2 days, the price performance, there's a 20% gap, right? So that's clearly not normal. Next page. One of the things that international investor, the reason why they don't like Asian market is the high volatility. You can see that on annualized basis, volatility in the Asian market is roughly 50–60% on annualized basis. This is about 2 to 3 times comparing to Hong Kong, right? So which sort of tells you there are something that the regulators need to think about, right? What's a more sustainable way to help the market to lower market volatility, and then as a result of that, attract global investors. So next page, I think there are a couple of key issues in the coming quarters that the regulators needs to work on in order to get the Asian market back to normal situation. Let me go through them very quickly. Next slides. The first one is obviously in order to stabilize the market, the controlling shareholder, significant shareholder, and also senior management. So previously, they can, after the 3-year lockout period, they can sell their shares to the market, which actually was one of the key reasons why we downgraded Asian market to sell in April. Because these guys, this private entrepreneur, they sold almost $500 billion in the first half. Essentially they're thinking the price, is far exceeding the intrinsic value. So that's why, in July, CSRC decided to, this is an administrative order for all these selling activities. They're prohibited for 6 months. So as a result of that, you can see that going into July and August, the net selling becomes net buying. However, by January next year, this is going to expire, right? The prohibition will expire by January, and when that happens, the pressure will be renewed. Next slide. And also we know that they have suspended IPO in order to stabilize the market. And historically, the IPO has been suspended 8 times, and on average, we're talking about 3 quarters suspension. So which means, by 2nd quarter next year, all these IPOs will have to come to the market, and there are over 600 of them in the pipeline. And clearly, when that happens, that there will be renewed pressure again in the Asia market. Next slide. I think everyone is sort of talking about Shenzhen Hong Kong Stock Connect, which the government has made this one of the wish list, one of the task lists they have to complete by the end of this year. However, if you look at what has happened in Shanghai Hong Kong Stock Connect, certainly since the stock market rout in the Asia market, foreign investors, they're selling out of the Asia market. And as a result of that, you can see the daily quota utilization for both the northbound going into the Asia market and the southbound coming down to Hong Kong, they have averaged negative in the second half. So which means it's kind of difficult to find a very optimistic suitable timing to roll out Shenzhen Hong Kong Stock Connect, because even Shanghai doesn't have much interest. The fourth issue I want to talk about, next slide, I think on SOE reform, right? We have been talking about this for probably 2 years' time, and so far I would say what the SOE reform has delivered, I would say it's under the expectation of the market participants. It's widely expected that the national guideline on SOE reform will be released in the coming weeks, if not coming days. So it should be interesting to see what the new round of SOE reform could bring in order to reinvigorate the SOE companies in China. I think at the end of the day, there are some key metrics that international investors are looking for to assess how successful SOE reform could be. First and foremost is this going to lead into much smaller overcapacity situation, which means they would have to cut overcapacity more aggressively, and that's obviously contradictory to the growth, the target maintaining 7% growth. And the second thing is on corporate governance, right? Will the board of directors for SOE companies be given independent power in order to make strategic decision, in order to hire senior management from the market and reward them in a market competitive manner, so on and so forth. So I think there's a lot of remains to be seen, and certainly global investors, they don't like what they have seen in the past. For instance, the merger between CSR and CNR, those kinds of merger creates an even bigger monopoly, right? But in the meantime, you can hardly see how that's helping the company to revive profitability, and more importantly, how will that helps then to better align the interest between the controlling shareholder, i.e. the state, and the minority shareholder, i.e. the global investor. So this is going to take some time before investors they can feel more comfortable. Next two slides. The next one. I don't want to sound too pessimistic on the Asian market yet. I do think that the interim results, we're seeing some silver lining in terms of fundamental. As you can see, the chart on the right-hand side, for all the listed companies in the Asia market, the gross margin has actually rebounded 2 percentage points for the past 2 years' time, thanks largely to the much lower commodity prices. And the issue really is operational margin has been risen at a much less magnitude, i.e. 50 bips for the past 2 years' time. So at the end of the day, I think in order for profit growth to return positive, we need to see more pick up in terms of operational margin as well as revenue growth. Next page. The operating margin, as you can see from the left-hand side chart, in the second quarter, we're seeing much higher operating margin. This is largely due to much better cost control. Part of that is because of the anti-corruption campaign. Part of that is because companies are really focusing on cost saving in order to boost profit. You can see both the selling cost, G&A cost, and financing cost, they're all coming down. So we need to see this continue. And more importantly, we need to see the demand to pick up in order to drive better profit growth. Next slide. And this is also one of my favorite charts. As I've showed you, right, PPI has stayed in negative territory for over almost 4 years. And one of the key reasons is obviously overcapacity. And the way to show that is the chart on the left-hand side. This is for all the A-share non-financial companies, the total capex spending divided by depreciation. If this ratio is above 1, that tells you there are capacity built up in the for the listed company. So you can see that for the past 20 years' time, the capacity built up has averaged 2.3 times, i.e., whenever you have $1 on depreciation, you got $2.3 spending on capex. This, the good news is that companies, obviously, they're taking, signal from the market. They're cutting their capex spending. As of first half this year, the capex spending is only 1.6 times compared to depreciation. So that's the good news. But bad news is that this needs to stay at this kind of level or maybe even lower level for much longer in order to get the pricing power back. So the PPI is unlikely to return into a positive territory probably over the next 2 years' time. So it's going to take much more forceful efforts depending on the progress on SOE reform, to what extent they can cut down overcapacity. The sooner the sooner they cut overcapacity, the sooner profitability will return, and the sooner the market could start another upturn cycle. Next slide. This is obviously the capex is spending across different sectors. We have seen most of the adjustment in the cyclical sectors like energy, materials, and also telecom. Not surprisingly, all these sectors are heavily state dominated. Next slide. Talking about demand recovery, I think the two key issues to watch really is number one, the property investment, and secondly, infrastructure. In terms of property investment, you can see that property sales has recovered for the past 5 or 6 months already. That's the first chart. The second chart, you can see that, I'll go back to the previous slides. Yeah, the second chart, basically most of this price recovery, transaction volume recovery happened in first-tier cities. So that's why when you look at the third chart, the property investment in China continues to decelerate. Now, it's pretty much the same level as we have seen in 2009. So whether property investment can pick up, I think, that's a key question, whether the economy could gradually, rebound to stabilize in the second half. The leading indicator is land sales in China. The land sales for the companies, the property companies we cover, land sales started to go up in June and July. And the reason behind that is because CSRC, greatly loosened the regulation. Essentially, the CSRC, instead of prohibiting property companies to issue corporate bonds, now they're encouraging property companies to issue corporate bonds. So we're also seeing increased volume in terms of corporate bond issuance by property company. And as a result of that, land sales has recovered in June and July. So reasonably speaking, given 1 to 2 quarters time lag, we should be able to see property investment to start to recover. So that's one of the two key reasons why we think soft landing is still the most likely scenario. Next slide. Infrastructure spending. I think both Mr. Lian Ping and Mr. Song have talked a lot about infrastructure spending. I think this is actually has the most visibility. Take the railway investment as an example. This year, China has budgeted 800 billion, right? But in the first half, they've only completed 1/3 of 800 billion budget. So which means in the second half, we should also see, because of the seasonality, a pickup in infrastructure activities. So for those two reasons, we think that the hard landing scenario is unlikely. Most likely, we're still going to get a soft landing in China. So that's why, if you go to next page, when you on top of that, China is also, and clearly, in addition to all this, fiscal spending, fiscal stimulus, monetary easing, there are also a lot of things going on in China, right? If I can give you one piece of data why you should be optimistic about China, that's actually the new business formation, right? This photo is actually primarily Ke Qiang drinking coffee in 3W cafeteria. That's actually a technology incubator and so which is sort of a symbolism. That's a symbol of the new economy in China. The new business formation in China last year, the number is 3.6 million. Okay, so every single day there are 10,000 new companies being set up in China, right? And this is 6 times compared to the US. Okay, this is 18 times compared to the UK. So, you know, that piece of data actually speaks a lot how much the government has done for the past 2 years' time in order to facilitate innovation by everyone. And then this is actually, throughout China's history, this is probably the best area to be an entrepreneur in China. So that's also, with that, that's why we think, go to the next page, the next one, we think that, you know, China's capital market still has a lot of room for growth in the medium to longer term. The chart I want to emphasize is to your left. That's actually the so-called Buffetter indicator, i.e. total market cap to GDP. You can see even if you add up the domestic A share plus the H share red chips listed in Hong Kong, this ratio now it's around 75% in China. Okay, in comparison, in the U.S. this ratio is 130%, and for the past 10 years' time, this ratio in the U.S. has averaged 110%, i.e. the total stock market cap is 1.1 times compared to U.S. GDP, which is about, you know, 15 trillion US dollar. And then, you know, that's why we think that there's huge room for growth as long as China can grow through, you know, this long period of, you know, economic rebalancing. And then that's why we still think that this is you know, this is the second largest capital market in the world, and there are still, although the whole market may continue to struggle, consolidate in the coming quarters, now actually it's time to look at the selected investment opportunity even in the Asia market. So I will stop here. This is my presentation. Thanks for sitting through this. I know it's almost lunchtime.